Hello everyone, and welcome to another weekly update on my investment portfolio. I'm thrilled to share the latest developments with you. It's been another fantastic week for the markets, and my portfolio has swelled by a healthy £1,600. This is a significant boost, and it's always exciting to see such positive results. This brings my total gains over the rolling month to around £5,000. Not too shabby. It's a testament to the strategies we've been discussing. The positive market sentiment following the US election has certainly played a part in these impressive returns. The market's reaction to political events can be quite impactful. This week's gains are a testament to the power of long-term investing and a well-diversified portfolio. Diversification helps in balancing the risks and rewards. By spreading your investments across different asset classes and sectors, you can create a more resilient portfolio. You can mitigate risk and capitalize on growth opportunities as they arise. This approach has been particularly beneficial in the current market climate. As always, remember that past performance is not indicative of future results, so it's important to stay informed and adaptable. But I'm feeling optimistic about the future. There are many exciting opportunities on the horizon. Stay tuned as I delve into the specific drivers of this week's performance, including sector-specific trends and key stock movements. One highlight is a welcome dividend payment from a tech giant, which has been a reliable performer in my portfolio. I'll also share my strategy for reinvesting those dividends for maximum long-term growth. Let's get started and dive into the details. One of the highlights of this week's portfolio performance was a dividend payment from tech giant Apple. This payment is a reminder of the consistent returns that can be achieved through strategic investments in well-established companies. Apple, a company I've held in my portfolio since 2018, pays a dividend 4 times a year, with an annual yield of around 0.44%. Although this yield might appear modest at first glance, the reliability and consistency of these payments add up over time, contributing to a stable income stream. While this might not seem like much, it's important to remember that dividends can provide a steady stream of passive income for investors. This passive income can be reinvested to purchase more shares, thereby compounding the growth of your investment over the long term. Since I first invested in Apple back in 2018, the stock has appreciated by over 60%, demonstrating the power of investing in high-quality, growth-oriented companies. This significant appreciation, combined with the regular dividend payments, showcases the dual benefits of capital gains and income generation. The combination of share price appreciation and regular dividend payments has made Apple a cornerstone of my portfolio. This dual approach not only enhances the overall value of my investments, but also provides a sense of financial security and growth potential. In the next section, I'll discuss the importance of balancing growth stocks like Apple with high dividend-paying stocks to create a well-rounded portfolio that meets your individual financial goals. This balance is crucial for achieving both short-term income and long-term growth, ensuring a robust and resilient investment strategy. When constructing an investment portfolio, it's crucial to strike a balance between growth stocks and high dividend-paying stocks. Growth stocks like Apple are companies that are expected to grow at an above-average rate relative to their peers. These companies typically reinvest their profits back into the business to fuel further growth rather than paying out dividends. On the other hand, high dividend-paying stocks are companies that distribute a significant portion of their earnings to shareholders in the form of dividends. These companies tend to be more mature and established, with stable earnings and a proven track record of profitability. By including both growth stocks and high dividend-paying stocks in your portfolio, you can benefit from the potential for capital appreciation offered by growth companies, while also enjoying a steady stream of passive income from dividend-paying companies. Section 4. Reinvesting for long-term growth. One of the most effective ways to grow your wealth over the long term is to reinvest your dividends. Rather than spending the dividend payments you receive, reinvesting them back into the market allows you to purchase more shares and benefit from the power of compounding. Personally, I reinvest my dividends into a mix of high-yielding REITs like Arbor Realty Trust, which boasts an impressive dividend yield of 11.59%, and supermarket income REIT, which offers a respectable yield of 8.72%. These REITs provide a steady stream of passive income while also offering the potential for capital appreciation. By reinvesting my dividends, I'm essentially putting my money to work for me, allowing it to grow exponentially over time. Section 5. Building a steady dividend stream. While high-yielding REITs form a core part of my dividend reinvestment strategy, I'm also conscious of the importance of diversifying my income stream. To that end, I've been strategically increasing my holdings in companies like Altria and Vici Properties, particularly during months with lower dividend payouts from other holdings. This approach helps to ensure a more consistent monthly income stream from my portfolio, regardless of fluctuations in individual dividend payment schedules. Section 6. Understanding dividend payment calendars. Speaking of dividend payment schedules, it's essential to understand the concept of dividend payment calendars. These calendars are crucial tools for investors who rely on dividend income. Each company that pays dividends has its own unique dividend payment calendar, which outlines the ex-dividend date, record date, and payment date for each dividend distribution. These dates are important for investors to track. The ex-dividend date is the date on which a stock trades without the value of the next dividend payment. This means if you purchase the stock on or after this date, you will not receive the upcoming dividend. The record date is the date on which you must be a registered shareholder to receive the dividend payment. This is typically 1 business day after the ex-dividend date. And finally, the payment date is the date on which the dividend is paid out to shareholders. This is the day you will actually receive the dividend in your account. By familiarizing yourself with the dividend payment calendars of the companies you invest in, you can better plan your investments and ensure that you're eligible to receive the dividend payments you're entitled to. This knowledge can help you maximize your investment returns and manage your cash flow more effectively. Section 7. Join me on my investment journey.